Good day, Iggy. For today's interview series, I'd love to dive into something I see a lot, dollar cost averaging, or DCA. Many investors stick to it as a habit, but I'm wondering, does it always make sense? Are there times when it's better to change things up, especially for us in Singapore?
Hey Ivana, good morning. You're spot on. This is a question I get asked a lot, and I'm really happy to break it down today. As you know, I'm Iggy, and I've dedicated my days to covering stocks, CPF, and smart ways to grow your wealth right here at the Investing Iguana. It's been quite a journey. Our channel just passed 1 million reads and 60,000 likes, was ranked 8th in the 2024 Influential Tigers by Tiger Brokers, and has chalked up over 1,000 videos with more than 600,000 hours watched as of August 2025. I keep close tabs on what's happening not just in Singapore, but across the region and globally, so DCA, and knowing when to sharpen or switch it up, is right up our alley.
Fantastic. Let's start with the basics. Why do so many investors in Singapore stick so firmly to DCA? And what could go wrong if you just follow it on autopilot?
That's a great place to kick off. DCA is popular because it feels safe and easy. It's like setting your alarm to wake up at the same time each day. A good habit, especially when you're starting out. You put in a fixed amount every month, rain or shine in the markets, and the hope is that it smooths out the highs and lows. The risk, though, is falling asleep at the wheel. Life changes, markets move, goals shift. If you keep DCAing without checking if your plan still fits, you might miss better opportunities or even fall behind. Imagine if you're climbing Bukit Timah, but the route changes and you're still walking the old path. DCA should serve the plan, not the other way around.
So let's say life throws you a curveball. Maybe you get a big bonus or the market suddenly takes off. Should you always stick to the same DCA, or could it make sense to change gears?
Excellent point. You should absolutely rethink your plan when things change. There are 7 big reasons to adjust your DCA. You get a windfall, say a huge bonus or inheritance. Your portfolio drifts far from your goals. You can use tax perks from accounts like CPFIS or SRS. Your emergency stash is strong. Markets are in a clear uptrend. Switching to lower fee funds is possible. You have high conviction in a new investment. Take windfalls. Say you receive a big year-end bonus or an inheritance. If your goal is long-term growth, you want most of that money working as soon as possible. Historical data shows lump sum investing, putting in the full amount at once, often leads to better returns because markets tend to rise over time. It's a bit like planting all your seeds at the start of the rainy season rather than one a week and missing the early growth.
I like that analogy. But what if someone is nervous about investing all at once, especially if markets look shaky or valuations seem high?
That's a real concern, and it's where emotions often trip us up. One way to meet halfway is the regret budget. Invest 70% to 90% of the lump sum right away, then spread the rest over the next 2 or 3 months. This gives your money a head start, but leaves room to act if markets dip. But I always tell investors, write down your process. Spell out when you'll DCA, when you'll go lump sum, and what signals will trigger a change. That can be as simple as a checklist. That way, you move based on rules, not just vibes or headlines.
How does this work with Singapore's wrappers like SRS or CPFIS? Do those change your strategy?
Yes, wrappers matter. A lot. For SRS, the earlier you contribute and invest, the more benefit you get, both from tax breaks and compounding. For CPFIS, leaving cash idle, just sitting there in your investment account, means you miss out. The menu is stricter with CPFIS, but within that menu, your job is to keep money invested according to your need and risk. So don't wait till December to top up your SRS. And don't let cash linger uninvested in CPFIS. Plan contributions and investments early in the year. For both wrappers, the mechanism is simple. More time invested means more compounding and, with SRS, lower taxes in the long run.
Under what conditions should someone use DCA as their main approach? When does it work best?
DCA truly shines when markets are falling and headlines are scary. You're prone to emotional decisions, like selling everything during a dip. You want to build discipline as a new investor. It helps you stick to your plan and avoid panic selling. Automation, setting up auto investments, removes emotion from the equation. You can even set aside a small fund for rare override moments in case a no-brainer opportunity pops up. But the habit is what wins long term, not trying to outguess the market.
Let's make things real. If I'm looking at my portfolio and realize it's drifted far off my target allocation, should I use DCA to rebalance? Or is there a better way?
Great scenario. If your portfolio is a long way off from its goal mix, say your stocks swelled while bonds shrank, you want to fix it fast, not slowly. Slow DCA rebalancing can let risk build up and pull you even further off course. So, rebalance in one move with a lump sum to reset to your target. After that, use DCA only for new contributions. Also have guardrails, bands of 5 to 10 percentage points above or below your targets, so you know when you must act but aren't tinkering constantly.
That's smart. What about switching funds? Let's say I'm holding some expensive, actively managed funds and want to move to something cheaper. Should I DCA the switch or do it all at once?
When switching from high fee to low fee funds, say from an active unit trust to an ETF, you should do it in one go. This immediately stops the fee bleed and simplifies your portfolio. Think of it like clearing out an overstuffed backpack. Suddenly, things feel lighter and easier to manage.
That's a fantastic point, Iggy. And for those who want to see the exact data on DCA versus lump sum, or any rules of thumb you use, where can they find those deeper resources?
Absolutely. We went deep on this over at the Investing Iguana Substack. For anyone wanting all the stats, charts, and written analysis behind today's conversation, just check out our Substack page. You'll get more numbers, scenarios, and step-by-step guides on making DCA and other strategies work for you. I always recommend reading the written version alongside the video.
Love that you make data so accessible. Now, if the market trend turns strongly positive, earnings are up, more stocks are rising, everything looks bullish, should investors speed up their investing? Or do you worry about jumping in late?
When trend, breadth, and earnings are all positive, you want to put money to work more quickly. If you DCA too slowly, you can miss out on meaningful gains. In those times, shorten your ramp. Maybe spread investments over 0 to 3 months instead of a year. Use bands or allocation limits to avoid overcommitting. Review your exposure monthly and stay within your risk plan. The point isn't to throw discipline out the window, but to match your entry speed to the regime we're in.
There are times when markets get really bumpy, or people aren't sure when assets are truly cheap or just look cheap. How should investors use DCA or lump sum in rare opportunity scenarios, like a sudden crash?
Excellent scenario. When there's genuine dislocation, say an asset drops 30% overnight due to panic, but the fundamentals are intact, it can pay to take a bigger first bite, then ramp the rest in over a short time. But always check both price and quality. Avoid value traps. Set triggers for additional buys and document limits. If facts change, change your approach. Don't get stuck to your anchored first price. It's less about timing perfectly, more about moving boldly when the odds are on your side.
Iggy, before we wrap, can you synthesize your key takeaways? If you had to boil down your approach to DCA versus other methods, what would you advise Singaporean investors?
Here's my playbook. Don't follow DCA by default. Use it when it fits your risk and the market's mood. Lump sum wins, on average, if the market is rising and your time horizon is long. For windfalls, invest 70 to 90% upfront, the rest over 1 to 3 months if needed. Rebalance big allocation gaps in one step. Use DCA for new money. Automate as much as you can, especially within SRS and CPFIS, funding early in the year. Segment your portfolio into sleeves, taxable, SRS, CPFIS, and set separate targets and calendars. Always write down your playbook. Set clear rules, guardrails, and review dates. Most importantly, stick to your plan. Don't let noise or other people's habits derail you. That's how you build wealth steadily, year in, year out.
Iggy, that was incredibly insightful. Thank you so much for breaking down how and when to sharpen DCA for us today. I certainly learned a lot, and I think our viewers did too. Before we sign off, for those who truly value this level of insight, what's the best way to stay ahead with the Investing Iguana?
My pleasure, Ivana. For those who want to get ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else. You get my in-depth analysis and urgent updates on market moves direct to your inbox, giving you a critical head start. It's just $3 a month, about the price of a kopi at Yakun. Think of it as your reliable daily dose of financial fuel, delivered before the rest of the crowd. If you're ready to get that edge, click the link in the description to become a premium member today.
Absolutely. Thank you, Iggy, for sharing your wisdom. I can't wait for our next video session together.